So there really is only two paths that you could go down when it comes to learning how to trade. Path number one is the traditional path, which leads to a 95% failure rate. And then path number two is the actual success path that probably less than 5% of traders are actually finding. In this video, I'm going to show you the difference between those two paths so that you can compare and figure out which path you're currently on. Then I'm going to give you the actual tools that you need to get on track and get on the right path. Hey, my name is Wade Guth. I've been in the trading industry for over 13 years. I've been down every single rabbit hole you could imagine. I've learned what works, and I've built a community of thousands of traders that I've taught how to do what I'm about to teach you. I make these videos because they are what I wish I had when I first got started. My goal here is to dramatically shortcut your learning curve. Let's get into it. First thing losing traders do on the traditional path is they follow the crowd. Here's a newsflash. This business is not built for you. It is built for you to lose. The brokers, the introducing brokers, the market makers, everyone that makes up the big infrastructure of this business wants to take your money. They are not your friend. On the traditional path, traders are going to look at mass marketed forms of technical analysis. They're going to try different types of systems and strategies. They're going to look at endless amounts of indicators to try to tweak them and figure out how to get them to conform to the market and show them how to get in and get out. They're going to follow the news. They're going to listen to the experts on what it is they should invest in or what they should be doing next. The facts is that the success path includes none of this. In contrast, those on the 5% success path follow the money. This means they do an honest industry appraisal. They look around and say, who's making all the money in this business? Well, certainly the banks are making money, right? How do they pay for these skyscrapers and these gigantic bonuses that they get, right? Those guys are making money. The traders that work there are typically making money. So what is it that they're doing? How do they operate their business? That really is the only thing that you need to be worried about as a trader. You need to understand who's moving around the markets, how are they making money from the markets, and then you need to find your niche within their system in order to extract profits for yourself. And we're going to get into that in a minute. When it comes to making trading decisions, traders that are on the 5% success path are asking these three main questions. Question number one, what does dumb money believe right now? What does the rest, the masses, the ones that are following the traditional path, what are they thinking? What do they believe is going to happen from this price level? Those are questions you want to know. You want to know what's going on in their head. Why? Because they're likely to lose. Question number two, how are the banks going to make a profit from the beliefs of these lesser skilled traders? How are they going to make money from this situation? And then question number three is, how do I need to be positioned knowing what I know about what the masses are thinking, knowing what I know about how the banks make money? What do I need to do as someone who's looking over it all? How do I need to be positioned to make my profit? On the traditional path, these traders want to manage their emotions. They want a 100% rules-based system that they could just execute by following the rules. That way they can try to take all of their emotion out of trading and become robotic. You're never going to be able to eliminate all of your emotions out of trading. And guess what? Understanding emotions, your own and others in the market, is a superpower. The traders on the 5% success path trade based on emotional analysis. They analyze their own emotions to understand the decisions that they're making, but better yet, they understand how to analyze the emotions of the masses. The best trades that you will ever make are because other traders are in emotional pain. They are in a situation where they have gotten into a trade they should have not have gotten into, and they are in pain, which is creating the opportunity for you to come in and make a good quality trade with them for yourself. I'm going to share a quick secret with you about how the banks use traders' emotions against them. Let's take a look at this example. Right here, you can see we have an uptrend that has formed on the example, and then we go into what we call the contraction phase. Now, the contraction phase is a consolidation not only of price, but it's a consolidation of beliefs. This makes a neutral point in the market where traders aren't totally sure whether price is going to continue up or it's going to go down. So they're confused. What happens next is the banks and market makers will push price into what we call the expansion phase. In this phase, they are trying to trick traders into doing the wrong thing. So at this point, a lot of traders will start to buy the market as they see that it's breaking out through this level right here. But little do they know that they're about to get rug pulled. So what happens next is that as they start buying the market as it's going through this breakout, they put their stop losses between the recent localized low. So what ends up happening is this creates a prime opportunity for banks to get traders net long and then dump supply into the market and then run their stop losses down in this area. Now, what makes this so amazing for the banks is that when traders are in pain, it creates a very predictable response. When a trader's in pain, they want to get out of their trade because it hurts. They're losing money. It doesn't feel good. And that's the most predictable response in human nature. If something is painful, we want to withdraw. We want it to stop immediately. So the banks count on traders being put into pain in order to count on their transactions that are going to result from that. So as they close their trades in this area, the banks are going to take the other side of those stop orders. At this point, after the traders have harvested those stop losses, they're then going to turn the market up and push it into the trend phase, which is our third market phase. And this is where they actually start making money. And the irony is that this is what these traders right here had already predicted. They thought that the market was going to continue in the overall uptrend, but guess what? That's not going to be a high earning move for the banks. The banks are going to drive it down. They're going to accumulate discounted liquidity, and then they're going to let the market run off in the intended direction. And then guess who they're going to sell their positions to? They're going to sell their positions to the same people that came in here. Those people are going to jump in up here as well, and the bank is going to match those positions for a profit of what they accumulated down here at discount prices. This is going to happen over and over and over again, and the banks count on emotional traders transacting in this way so that they can make a profit. Here's another secret you need to know about emotions in the market. All of the money at play in the market will eventually flow from the emotional and impatient to the non-emotional and patient. It's just a matter of time. The crazy thing is that these two different types of people experience emotions the exact same way. The only difference is the beliefs and the infrastructure in which they operate. These people down here who make all the money have infrastructure and beliefs that allow them to be non-emotional and extremely patient in the market, versus these people up here that lose all their money operate with beliefs and infrastructure that cause them to be overly emotional and causes them to be extremely impatient. This brings me to my final point in this video, that traders that are on the 95% losing path are usually trading their own small account, and they are taught that they could take a small $500 or $1,000 account and turn that or flip it into this big life-changing amount of money. And in reality, there is a couple of people that have been able to accomplish that, but for the vast majority of you watching this video, it is never, ever going to happen. The good news is that that's okay. All the people that are on Wall Street are not flipping small accounts. They're doing something completely different, and so can you. The biggest banks and the best traders in the world all know this one thing. They know the more money that you control, the more money you can easily make. It's all about trading other people's money. So let's think about the edge that institutions have, starting with their account structure. We think about it, they're trading large accounts because they're raising capital, right? So let's pretend that they have $100 million allocated to a specific asset class managed by a trader or a group of traders. On that $100 million, they're collecting fees. They have somewhere between a 1% and 2% management fee. So we'll go with the 2% management fee. And they're also getting a 15 to 20% performance fee on anything they make on that capital. So if you think about this from the institution's perspective, not only the manager, but the traders, what are the incentives here for these specific people? Here's the true incentives for an institutional trader, and this is what gives them their edge. Number one, they want to protect their capital at all costs. They don't want to lose money. If they do a good job at that, they're going to, number two, satisfy their investors. They're going to keep their investors around. If they do a really good job at that, then number three, they're going to be able to raise more money, which is really important because that leads to number 4, which is collect more fees and get bigger bonuses. That's really what they're after. That is their business, is fees and bonuses, right? So the cool thing is, as they satisfy investors and raise more money by bringing new investors on, they get more fees, they get bigger bonuses, but they also have the opportunity to lower their risk and increase the longevity of their business. So that's number 5, lower risk. If they do all these things right and they keep raising a bigger and bigger pile of money, they can continue to get what's important to them, ever increasing bonuses, ever increasing fees. And number 6 is they can do it forever. This is the true trading business infrastructure that Wall Street is built on. Raise money, satisfy investors, collect more fees and bonuses, and keep growing it bigger and bigger and bigger. And don't take risks to break up this business. Don't sabotage it. So now I'm going to give you a plan that you can start to implement that will help you play at the bank's level. It'll help you establish a similar infrastructure and think along similar lines as how they think and how they grow their businesses. So your plan, step number 1, is that you need to learn how to trade the master pattern. This is something that I'm known for, and it is my spin on accumulation distribution. Here's a brief overview of what the master pattern is all about. The master pattern consists of 3 price action phases. Starting with phase number 1, we call this the contraction phase. It's a tightening of price. That leads to phase number 2, which is what we call the expansion phase or the price exploration phase. And then that leads to phase number 3, which is the one we're all after, the trend phase. This is where we get that significant move to higher or to lower prices. What I can say about the master pattern is that this model fits into any market. It works on all time frames, and it is always happening. Every single candle that you're looking at can be classified as part of one of these 3 phases. And once you understand that markets move in a sequence of phases, as opposed to specific price patterns like wedges and all these different candle patterns, once you understand that this is behind the scenes operating all the time and you attach yourself to the sequence, you will be incredibly amazed at how well you can predict the market by understanding these phases. Now, I teach extensively about how the master pattern works and how you can learn it all throughout my YouTube channel. But if you really want to drill down, you can go to my website at tradeats.com and take my free Master Pattern Academy course. It's 8+ hours long of content that teaches you exactly how to understand the master pattern, along with many other concepts that I teach. So go get it. It's free. It'll handle this part of your trading plan. Number 2 is you want to learn how to read emotions in the market. In fact, emotion is what creates the master pattern. That's what it embodies. It embodies beliefs being manipulated and the banks taking advantage of those beliefs for their own profit. So when you put the master pattern together and you put together how emotions are playing into that pattern playing out, it gives you an incredible foundation to make amazing trading decisions. I'm going to put 3 and 4 together because I think they go hand in hand. You want to raise money and lower your risk. The same way that the big banks are raising money so they can raise their fees, raise their bonuses, you want to be able to do the same thing. If you are trading on a big amount of money, you can take much less risk and still make money that is significant for your life. That is the key to doing this for a really long time. All the rest of the traders out there that are part of the losing 95% are taking a small amount of money, something that they're scared to lose. They're leveraging it to the max and hoping that they just hit a big win. It's never going to work out for most of them. So do the opposite. Raise money, lower your risk, do it forever. And the best way to do this is through prop funding. Now, I'm not here to advertise any specific prop firm, including our own. What I'm going to tell you is that you want to do your own due diligence and you want to find a reputable prop firm that gives you a real account, not simulated funds, and that gives you an evaluation that has no timeline. You do not want to be pressured to have to make trades. The market does not always give good opportunities, so you want to make sure that you can wait till the conditions are right and not have that pressure. Once you find that prop firm, you want to make sure that you can raise a lot of money inside that firm. That's going to be your key to establishing the same type of infrastructure or situation that institutional traders enjoy. That's what gives you the ability to make a lot of money and take less risk, which is the key to surviving and having staying power in the market. While the rest of the traders are out there blowing account after account, you're working hard at conservatively passing an evaluation and getting real funds under management. That is going to be the key to establishing your professional trading infrastructure for yourself. And number 5, the last thing I'm going to tell you to do as part of your plan is to develop a long-term perspective. This is so important. All the traders that are losing are trying to get rich quick. They're trying to take the easy way. They're trying to subscribe to a signal service. They're trying to find that magic money printing indicator. That's not for you. You are a professional. You're trying to raise money that you can keep for a long time so that you can establish your own funds, your own significant pile of money. And that's going to take a long-term perspective. That's what people on Wall Street are doing. That's what the banks are doing. They're not looking for the big gamble. They're looking to be here for 100 years. You want to mirror everything that they do because they've modeled what success looks like. All we have to do is set ourselves up in a similar way, and then we can enjoy that same type of long-term success. And that's it. I hope that you got a ton of value from this video. Remember, take advantage of my free course. The link is in the description. Until next time, I'll catch you later.